For today's Did You Know section, we're going to get into ways that you can actually manage the higher interest rate environment. I had a call with a couple great clients this past week, and they actually brought up this question. They asked me if myself and my company here at Rate offers temporary buydowns, 2-1 buydowns, 3-1 buydowns. And for us to go into discussion about this, I want to make sure that I make clear what buydowns are. So we've talked in the past about discount points. That's when you pay a premium upfront and it gives you a lower interest rate. And if you don't pay that premium, your interest rate is higher for your 30-year mortgage. We'll just discuss 30-year mortgages. So temporary buydowns operate a lot like the way it sounds. They are temporary relief for your mortgage payment and your interest rate that can be provided by way of a seller concession. How temporary buydowns work? It's part of the negotiation process where you're going to be placing an offer and you're going to say to the seller, all right, I'm placing my offer at $500,000 and we're putting 20% down, say, and I would like to ask you for, say, a $10,000 seller concession. That $10,000 seller concession gets used to create a subsidy, and that subsidy is held in an escrow account, which gets managed by your mortgage servicer after you close and affords you a lower monthly payment for a prescribed amount of time. And I know talking generally, it's a little difficult. So let's dive into a real world example and we're going to talk actual numbers so that you can see what a temporary buydown can get you. I mentioned a $500,000 purchase price, so that's what we're going to use for our example. $500,000 purchase price with 20% down, which is $100,000. Now you're looking at a loan amount of $400,000. Let's say your interest rate is the average that we discussed today, 6.95%. That $400,000 loan is costing you $2,647 per month. I'll leave the change out of it. First, you can explore a 1 buydown. A 1-0 buydown. This will let you will have your mortgage note and your interest rate will be 6.95%. However, for your first year of repayment of that mortgage, the effective interest rate of repayment is going to be 5.95%. That 5.95% would now have a monthly payment of $2,385 a month. So you can see that is almost $300 less. And that's savings for your first month. Well, that difference, that $300, that's what the subsidy is used to defray. So instead of making your full monthly payment at the $2,647, you're making that payment at $2,385. And the difference is actually paid for by that concession that you negotiated when you purchased the home. And that satisfies the full payment of the mortgage. So out of pocket, you're not paying the full amount and you have some temporary relief. There are many iterations. I'm just going to go through the 3 main ones. There's the 1-0 buydown, the 2-1 buy, and then there's a 3-2-1 buydown. All of these will then have increased amounts of the subsidy that's required. So now let's look at a 2-1 buydown scenario. Your first year, as you guessed it, your interest rate would be 4.95%. And your monthly payment would be $2,135. That's significant savings. Then your second year, you'd step up to the 5.95%. Then in the third year, your interest rate would be the 6.95%, and that monthly payment that you saw on all of your mortgage paperwork when you closed on your home. Then the 3-2-1 buydown is the even more extreme and gives you a little bit the most relief for the longer period of time. You get to see an interest rate of 3.95% in your first year, which translates to a monthly payment of $1,898 a month. And then it steps up to 4.95%, 5.95%, and then in the fourth year, that's when your mortgage steps back up to the 6.95%. As you can see, with each one of these, if you're going to have more savings throughout more time, you're going to need to request a higher concession from the seller. So in the 3-2-1 buydown scenario, you would need to be negotiating a seller concession for $18,297. That $18,297 is what's affording you the ability to make those lower payments for those 3 years. Another fringe benefit of these buydowns is, let's say interest rates do go down in 2 years and they're at a level that make a lot of sense for you to refinance. Well, the money that was put aside in that subsidy for your temporary buydown is available to you at closing to help defray your closing costs on your refinance, and or half dozen one way or the other this way, can lower your payoff amount. So let's say your mortgage balance after 2 years is $396,000. It's probably going to be somewhere in that range. You don't pay a lot of principal off early in your mortgage. So you'll have that subsidy and it will be reduced by whatever balance is left in that subsidy that your current mortgage servicer's been holding for you to support this temporary buydown. That being said, if you use that same money for permanent buydowns, you don't get that money back. So if you buy down your interest rate now when you purchase, and let's say you're able to get 6%. Right now, average is 6.95%, but let's say you buy down your interest rate to 6%, you have a lower payment that is not going to change, and that's great. But let's say interest rates drop significantly in a couple years, and you go to refinance, you're just going to be refinancing and there's not going to be anything else left over. Those discount points you paid or that you negotiated the seller to give you a concession in order to pay, that money is gone, bought and paid for the contract that was your mortgage for 30 years when you originally purchased the home. So there's a plus and minus. Things to bear in mind with all of these numbers that I mentioned. Number one, these numbers are just principal and interest payments. These are not payments that indicate a fully amortizing mortgage with taxes and insurance included. So if there's homeowners insurance and taxes, that's an addition. I wanted to keep it with the principal and interest. Secondly, temporary buydowns are great. However, you need to make sure you're comfortable with what that end payment is, because there may have been people 2 years ago that leveraged a 2-1 buydown thinking that, well, by 2024, I'll be able to get a lower interest rate and refinance. And right now, that may not be the case. So now they have to manage that higher monthly payment. So if you are interested in temporary buydowns, make sure you're comfortable with what that end payment is going to be in the event that you don't have the opportunity to refinance. And then thirdly, take into account everything. Take into account what it would be like. Do a comparative analysis of, well, if I'm getting a $10,000 concession from the seller, would it make more sense to have temporary relief for you and for your family and for your financial goals? Or would it make more sense to have the peace of mind of knowing that you have a fixed rate mortgage that is already discounted using that money, and you don't need to necessarily bank on if and when there will be a refinance opportunity in the future?